Today I'm sitting here on my own. Casper is traveling, but it doesn't matter. I'm going to try to entertain you for the next 10 to 15 minutes with a interesting story about the interest. We all know how difficult it is for this moment for the Fed, the Federal Reserve, to determine what will be the interest rate in the future. And we have been in a situation for quite a long time that we were in quantitative easing, so that the balance sheet of the Fed was increased. Now we're getting to a situation that the balance sheet is going to be tightened. So it's important to understand that the Fed is one of the most powerful institutions in the world. We all know Jerome Powell. And what is important that we know how to interpret his wordings, his messages. And on the 13th of December, they had their meeting. And in that meeting, it seemed like there was some sort of like a consensus that we are ready to lower the interest rates. And the market took that for granted. We saw the stock market going up from in the S&P 500, initially boosted by positive CPI figures. Positive is actually meaning negative because the inflation was going down. Then we saw the CPI slightly higher, and the minutes of the Fed show that the interest rates are going down. Now, the stock market liked that. They were very optimistic, and they are still actually very optimistic. And this is being recorded on the 18th of January. The market is like bouncing against the all-time highs. We can see that we're at 4,750 in the S&P. I like to use the S&P as a benchmark, 4,800. So it is a very important level where we are at. And the next coming weeks will be very determining. However, the year 2024, as we know, started quite negative. We had initially about 2-3% drop in prices of the stock markets, and that was mainly driven due to the fact that on the 3rd of January, the FOMC came out with their minutes. So the meeting was held on the 13th of December, but then the minutes were presented only on the 3rd of January. And what could we read from those minutes? Well, it's interesting to know, and I don't know, maybe you do know that when it is said in the minutes, several participants or several members, that actually means in Fed speak, if you look at this is a dictionary of Fed speak, the wordings that are used in those minutes, it means that the vast majority or many participants or almost all of them, so they were not agreeing on 6 rate cuts. So hey, the market all of a sudden started this like calculating, okay, what if not? So, and as we are now on the 18th of January, we still don't know what is going to happen at that moment. So who knows it may tell me. I don't know, and I think the Fed itself also doesn't know. What is important one of the most important things that we as retail investors maybe don't look at so often is the reverse repo facility. And I'm not going to go into very much details. It basically means that you give something and you buy it back at a higher price. All right. So basically, what is important is that the reverse repo facility means that central banks lend money to banks. A bank has a balance sheet, and if they have an excess in money, they need to post that or deposit that at the central bank. If they have a shortage of money, they have to, in this case, take a loan, and that's when basically the reverse repo facility. What is seeing is that the Fed, the reverse repo facility was going down. So we saw that banks had an excess of cash, and they were putting that cash at the Fed, at the central bank. So the balance sheet of the Fed was increasing, whilst the goal is to reduce the balance sheet. So that was a little bit of a other side of the story. They wanted to actually reduce the balance sheet, but because of the fact that the banks had an excess in cash, because of good results, because of interest income, or whatever it might be, they had to put that excess of cash at the balance sheet of the Fed. The balance sheet was increasing. So that was not really what they wanted. What Powell said in the minutes of basically during the meeting of the 13th of December is that his goal is to reduce the balance sheet of the Fed, to start reducing the balance sheet of the Fed by selling assets or liquidating assets or not renewing assets at that moment when the reserve of the Fed is at a significant level. That means that basically that means that they need to have a certain level of reserves before they will start bringing down the balance sheet. He said on top of that at this moment we are by far not at those levels. We have more or less some reserves of 3.5 billion, which is a lot of money, of course. But he said we are far off what we estimate as being a comfortable reserve level. So how do you have to interpret this reserve level? If we look back in the 2008-2009 crisis, the financial crisis, the Federal Reserve had by far not 3.5 trillion of reserve balance on their balance sheet. It was way less. At that moment, they decided to start increasing that reserve regime. Basically said we have to put more money on our balance sheet to save the banks, to help the banks to be able to facilitate reserve repos, etc. The problem is that the banks tried to, but initially they had a problem to get the reserves up to a certain level. And why was that? Because banks tried to give out as much loans as possible, so they did not have any excesses. They didn't have to put the money at the balance sheet of the Fed. They did not give the money to the Fed, or they did not lend the money to the Fed, how you want to call it. So what did the Fed do to keep their transactions or their activity lucrative for banks? Is they had to implement some specific interest rates. And those interest rates are called the IOPR interest and the RRP interest. One of them is, of course, the reserve repo facility interest. And those interest rates are approximately at 5.4 and 5.3%. So, okay, what can we conclude from all this? That basically the Fed is very closely looking at, for their decisions, on the activity of banks with regards to the reserve repo. The reverse repo. So not reserve, reverse repo. They look very closely, what are banks doing with their excess of money? Do they need money from us, etc.? It's a very important indicator for them to decide when to start reducing the balance sheet. And on top of that, of course, what I also mentioned, the reserve, not the reverse, the reserve regime of the Fed, which is not 100% clear what they want to have. If we look at 2024, I think there's a couple of things that are very important. One of the things is that we want to have a more normalized interest curve. We've been confronted with that by the end of 2022, we were at 0% interest. And by the end of 2023, we are at almost 5% in the US. So that's from 0 to 5 in just a couple of months. That's way too quick. That's way too fast. That hasn't happened in the history of the economy. It hasn't happened. We have seen interest rates hikes. We haven't seen it at a speed as quickly as it has happened now. Well, one of the points that of course made it positive for investors is that buying bonds became lucrative again. You could get some really good yields from buying bonds, which was not the case between the period, let's say, between 2012 and 2020, 21, 22 even maybe. There was no yield to be made on bonds. So if you look at our clients were not buying bonds. Why would you? Because you were actually having to pay sometimes even negative interest on those. Nowadays that is possible again. And there's a couple of scenarios that are important. What sort of landing are we going to get? Are we going to be having a soft landing, a hard landing, or are we going to have a landing of the economy comparable as with 2000, in the 70s? In the 70s, of course, we had a lot of geopolitical tension, a lot of things going on, and the inflation appeared to be very sticky. And Volcker at that time, he initially started cutting the rates, and then we don't have the effect that we really want. Volcker was the person in charge of that interest rate decision at that moment, and then they started hiking them again. So it seems to be at this moment that we are between a soft landing, which means that inflation is returning, and the economy is not slowing down, because we saw it. I mean, we had inflation figures last week. Inflation was strong, still 3.9%. Prices were even slightly higher. Yesterday we had the retail figures from the US. people are spending like crazy. So the US economy appears to be really, really strong. There's no signs of the fact that we are getting or close into a deep recession, which is called the hard landing. So we are in between those levels. Well, that means that basically there's a couple of scenarios. So that basically means that if we're getting into a situation of a soft landing or a 70s example, that the interest rates will stay around 4% for a longer period. At this moment, you could buy, for instance, a 10-year treasury bond from the US government, so a US dollar treasury bond that expires in November, has a redemption in November 2033. You can buy that with an effective yield of 4.1%. And then you might ask me, okay, but what happens if the interest rates starts going down? That means that that bond will go up, right? Or what if we get into a situation of a really soft landing and interest rates need to go even higher again? Then I make a loss, because we know what happens. The coupon, so the interest rate that in this case the United States is paying you, you divide that by the price of the bond, and then you take in consideration some redemption profit and redemption loss, is giving you the effective yield. Well, if in this case it is like that interest rates have to go higher, which is not a very likely scenario, the loss on your bonds, and I have this in a little table here in front of me, will only be if the interest rates go up 1%. So we go from an effective yield of 4, where we're at now, to 5. Then you will be losing on your bond position approximately 2%, which is not a lot. However, if on the other side, bonds are going down in effective yield, so we go from 4 to 3, which is a likely scenario. So we maybe go with 4 rate cuts of 0.25%, so 4 rate cuts of 0.25%. Then that means that the price of the bond, which is at this moment, I'll show you in the screen, 104, have to go up to 110 or maybe even higher. So that means that you will be having your interest payment and the bond will go up in price, and your return on your bond investment at that moment will be approximately 10%. So what is then the likeliness that effective yields on 10-year bonds will go above 5%? Is not very likely. If we look at last year we were in a phase of rate hikes, so interest rates were being increased, but there was very heavy resistance at 5%. Bond prices did not go higher, causing an effective yield of 5%. So now we're in a scenario that we're going to lose, that interest rates will go down again. So there's no real reason to think that the effective yield on a 10-year treasury bond will go at or above 5%. So if you want to, and you have dollars available, which you don't know what to do with, you don't want to put it into the stock market itself, like you don't want to buy stocks, but you are happy with a 4% return on your US bonds, on your US dollar, then you could consider buying this United States 4.5% treasury bond that runs until the 15th of November 2033. It is basically a deposit. You have, of course, the risk that the price, which is at the moment 104 and a little bit, goes down to 100. That means that your effective yield on your investment will go to 4.5%, so you have a slight loss. But on the other hand, if indeed there are rate cuts coming up, the price of this bond will go higher. And on top of that, you make 4.5% per year on your US dollars. Please note that when you buy this instrument, you have, of course, and you're living in Europe, you have your euro-dollar risk. But this is a very, very secure investment. It's a AAA. You buy US government, of course. A lot of things can happen if the United States goes into bankruptcy or whatever. If Trump comes back to the power, you don't know. There's a lot of factors that can still influence this. But with the knowledge that we have today, buying this 10-year USD Treasury bond will give you an effective yield of 4.1%. Any questions? Let us know. Next week, I'm hopefully again with Casper. Thank you for watching, and I see you then.